Welcome back to the Williams Real Estate Channel. I'm your host, Geordie Williams. Tonight, we are running through the August 2024 property market update. So strap yourselves in. This is going to be a big one. A lot of data, big deep dive. I'm putting all my energy into these instead of my newsletters. I don't think anyone really reads the newsletters anyway. So there's going to be a lot of things to unpack, starting off with the Australian CoreLogic dwelling prices month on month. So this is the average across Australia, 19th consecutive month of price gains by 0.5%. Perth, Adelaide, Brisbane leading the charge. Sydney, moderate growth. So Perth increased by 2%, Adelaide 1.4%, Brisbane 1.4%, and Sydney 0.2% in the month of August, with Canberra, Melbourne, Darwin, and Hobart slumping by 0.4% down in Canberra, 0.2% down in Melbourne, 0.2% down in Darwin, and 0.1% down in Hobart. So I guess not slumping, but subdued growth down in those regions. So a mixed bag. Not all regions perform at the same time. So we've got obviously Perth, Adelaide, and Brisbane mainstream going gangbusters, and other markets are performing differently. So very interesting. Now we have, Sydney is still the leading house median dwelling value for the largest capital city. Sydney historically typically leads. It's pretty much a global city that competes with the likes of Hong Kong, New York, Beijing. So it is the doorstep to Australia. So it is always leading as a medium dwelling value. Coming in second now is quite interesting is Brisbane. So historically, Melbourne is coming second. So Brisbane's in second place. Canberra's in third. Adelaide and Perth creeping up. And then we've got Melbourne has dropped down to, what's that? 3, 4, sixth position. So we are finding very good value down in Melbourne right now, and in certain pockets of Sydney, which we'll get to. Hobart, Darwin, we don't really look in those regions. So we stick to Sydney, Brisbane, and Melbourne, and potentially down the track we might look at Adelaide and Perth. But at the point of the current cycle, they are well and truly ship has sailed, and those markets are well overheated in my opinion. So we'll get to this in further slides. So some interesting data I've came across in the recent months, and this is the net overseas migration intake for financial years ending in 2022 and 2023. So we've had over 700,000 migrants enter Australia over the last 2 years, and they're flocking to Sydney and Melbourne as the most popular destinations. According to the ABS net overseas migrant data and the Institute of Public Affairs, Australia's net overseas migrants have surged by 732,000, and 29% have landed in Greater Sydney, and 28% have landed in Melbourne. So even though Sydney and Melbourne are more or less subdued growth compared to Brisbane, Perth, Adelaide, they are getting the most of the population growth from the recent net overseas migration. So that is very interesting. It is priming these markets for the next stage of growth because they've had over 57% of the population net overseas migration come into those regions. And Perth has only seen near 10%, Brisbane 9%, Adelaide 5%. So majority of the people coming into the country are going into Sydney and Melbourne. So you can never, I guess, get away from the fact that Sydney and Melbourne are probably the main driving regions over the long term for sustainable long-term growth. Yes, we are seeing, I mean, a sugar hit now from especially Perth and Adelaide. Brisbane's more stable, but um, Sydney and Melbourne are based off the 20 years of sales data, are less volatile and more stable markets to invest in. And this is backed up by where people are going. Next slide. So with the rate of overseas migrants coming to the country, it's soaking up all available rentals. So we are seeing the rental vacancy rates very low. So the rental vacancy rate is the percentage of available rental properties in a current market. So across Sydney, Melbourne, Brisbane, and Perth, the data is collected. So a stable market is around 3 to 4%. When it rises above 4 to 5%, that means there's a lot more rental properties on the market. It can be hard to lease your property out. When it gets below 2%, that's very tight market. So not very many available rental properties for people to rent. So right now, all the regions are pretty much below 2%, with Perth and Brisbane below 1%, Sydney's below 2%, Melbourne's probably just above 2%. So all the migrants coming in are soaking up all the available stock, and there's not enough construction and building keeping up with the demand. So prices will continue to keep rising as the demand is continue to outstrip the supply. Very good for property investors. On top of that, we've got, so the federal government's bringing in record numbers still of migrants, and most of them are wealthy migrants. They have completed university degrees, doctors, lawyers, nurses, people with skills, high paying jobs. And then at the same time, construction is lagging, but then on top of that, coming across these couple of interesting articles recently. So Sydney Water is completely under the pump. They can't keep up with the development demand. A lot of the infrastructure needed, so all the new roads, all the water sewer that goes into the new developments, Sydney Water just can't cope in Sydney in the Sydney region. So even though once the development starts to kick into gear and developers want to start building stuff, there's restriction on supply from this key infrastructure to even accommodate the larger developments. On top of that, we've got councils like the Canada Bay Council, who is not only trying to reject development applications, but they're also taking legal action around rezoning of plans from the state government to allow high-rise homes, so all within um, Homebush region and Strathfield. The Sims Labor state government is trying to rezone and promote development, and we've got councils rejecting it and even taking on legal action against the state. So we've got three layers of government that run their own agendas. That's the crux of I guess, the issue of the housing crisis that we are experiencing now. It has really never been this acute in history. We've got the Albanese government bringing in the record numbers of wealthy migrants to prop up the GDP numbers, because if it drops into negative, then we'll be in a supposed recession, and then he'll be voted out before he knows it. So that's why he's driving a lot of these migrants coming into the country to keep the GDP numbers positive and keep the economy kicking along, kicking the can down the road. The state government's doing the best they can to rezone and try and to promote development, but then we have these state-owned corporations such as Sydney Water that can't even cope with the amount of demand from these new developments anyway. So they're restricting, and then we've even got council who's flat out rejecting developments. So in order to increase supply, I would say the model needs to change to put the development approvals at the state level, which is quite similar to what's in America in the States. It's at a state level, it's not at a local council level. Local councils only really deal with cleaning up roads, keeping the footpaths clean, rubbish collection, those types of, I guess, minor operational activities. And a state level looks after the planning and approvals of development. So in Australia, we've sort of got the tail wagging the dog, with the councils having really the power of approving supply. So from a property investment perspective, that's still positive, because even though there's this chaos going on at government level, and you see it all over the news that we're in a housing crisis and there's lines of people outside rental properties, and rents are soaring because there's not enough rental accommodation, this all filters down to the benefit of landlords and property investors, because ultimately if you restrict supply of anything and there's a high demand, prices will keep going up. So I just find these type of articles interesting and almost amusing to see the complete chaos that's going on. But the more this goes on, it'll play in the hands of the property investors, because, as I said, if you restrict supply and increase demand, classic supply and demand equation, prices will keep going up for that product. So stay tuned, see what ends up developing in this space. But very interesting. Next thing is inflation. So the RBA has a target of 2 to 3% inflation rate. Currently, inflation is sitting at 3.8%. So it's above their target band. So rates are, even though there's big four banks and there's mainstream economists out there saying we potentially get a rate cut this year or next year, I don't see it happening until the market turns post 2026. So brace yourselves. I believe rates are here to stay for the rest of this year, and potentially there's more chance that they'll go up than down. So they're here to stay at least 4.35%, and probably will go up a couple more times. So we are bracing ourselves. We are preparing ourselves for rates to stay higher for longer. It would be nice, obviously, if they dropped them, but that would be inflationary. If they dropped rates, it would encourage a lot of further investment, more speculation. People would get all excited and start doing more business activity, which would be inflationary. So they're trying to be more restrictive on the economy to lower inflation. So it won't be until inflation is well and truly within the band and probably has a 2 in front of it until they will drop the interest rate. So brace yourselves and hang on. So that's where we are today. Moving forward, I use the 18-year land cycle as a framework to not only guide where I look to invest in terms of what region. As you've probably heard, if you've been following me for a while, the 18-year land cycle consists of 14 years of expansion, 4 years of downturn, and the 14 years of expansion is interrupted with a mid-cycle slowdown. The most recent example of that was COVID. And in the first half of the cycle, Sydney and Melbourne outperform. They then top out. They then go through a period of stagnation, of flat growth. People then decentralize and then look into more affordable markets such as Brisbane, Perth, Adelaide. That's when they then outperform in the second half of the cycle, which we are seeing now. And then the market will top out and then we'll go through the land-driven downturn, which is like a GFC-like event, which is the last time we experienced it was in the GFC, and the one before that was the 91 recession we had to have in peak in 1989 and downturn. So I use this as a framework to work out, okay, which market performs well and when, but also use it to manage debt levels, manage cash levels, understand where interest rates are going to go, because historically in the second half of the cycle where we are now on that yellow marker, inflation's high, interest rates are high, property prices keep running until the market tops out, and then something has to give, something will give, and then the sentiment will shift, and then we'll be going through the next land-driven downturn like the GFC-like event we saw in 2008. So this is what gives me, I guess, confidence, or my thought process around interest rates are going to remain higher for longer, because there is a larger cycle at play, this land-driven, this 18-year land cycle, which will drive, is driving the economy, is driving higher inflation, and it is most likely, based off history, going to keep interest rates higher for longer until the market tops out. So between 2002 and 2007, as an example, interest rates, or the RBA cash rate, went from in 2002 4.25% and went up to about 7.5% at the cash rate in 2007, before it then got dropped pretty quickly. So we're in that same point of the cycle now as we were in, say, late 2004. So there's another couple of good years of strong growth, high inflation, and higher interest rates. So it's still obviously a good time to invest. Property markets are still going to keep outperforming, but you just got to make sure that you got good debt coverages, plenty of cash in the bank, because rates will stay higher for longer. And you want to be able to sail through these higher periods of rates being higher, but then also be cashed up and ready to go to get the deals, because the deals are starting to pop now. People are getting forced to sell who can't hang on to their properties. So there's deals to be had. And especially when we go through the next land-driven downturn, that will be the best time to buy in this decade. So if you don't believe me around this, check these graphs out. So if you overlay the 18-year land cycle over 20 years of sales data, this is what I can show you for Adelaide. So Adelaide has pretty much we're in a similar part of the cycle in 2004. So we're here now. Adelaide's had a really strong run, but the equivalent point of the cycle is in 2004. So based off history, there's still a bit of growth for Adelaide up until, say, 2007, where it topped out, which will be 2026, 2027. And then it'll go through a period of protracted flat growth for, on average, 10 years, can be anywhere between 9 to 12 years, but on average 10 is where markets typically flatten out after their bull run. And then they'll outperform again in the second half of the cycle. So we are no longer looking at Adelaide. We think the ship is sailed. Most people, the mainstream, are ploughing in with FOMO, because once the market starts to go up in value, that's when most people try and plough in. But we like to get into the markets after a protracted long period of time. So after it's gone through a good 7, 8, 9 years of flat growth, because then that's when any time it will then kick into its next growth cycle. So that is the best time to buy in Adelaide, was around 2018, 2019, in preparation for its growth cycle in the second half of the 18-year land cycle, not now. Same goes for Brisbane. I bought a lot up in Brisbane between 2018 to 2022, and no longer recommending clients to buy there now. It's as you can see, it's kicked into its growth cycle as we're in the second half of the 18-year land cycle. Equivalent is 2004. It's got a couple of good years of probably another 2 years of solid growth. However, it'll top out and then it'll have another 10, 11 years of protracted growth. So as I said before, we like to get into the market after the period of flat growth prior to it kicking into its growth cycle, not while it's going through its growth cycle. And the reason for this is there's a couple of reasons. First reason is you can't get properties now in Brisbane for underbanked value because the market's going so strong. You have to pretty much pay overs to get in, and you're competing with the masses. You're buying at an auction. Once a market starts, all properties start selling at an auction in a market. That's not a really good time to buy. It's a good time to sell. Always sell at an auction if you can, but I've never bought an auction. I always like to buy either off market or private treaty. And the only time you can do that is when it's been a flat to negative growth for a long period of time, and the sentiment's not there and there's less competition. So you only get that before it goes through its growth cycle. But then also, if you buy now in Brisbane, the risk for the downside is higher because it's only a matter of time where it will top out like it did in 2007. It'll come off 20, 30%, and then it'll go back. It'll soften 20, 30% from the top, and then it'll go flat for 10 years. So you don't want to get into a market at the top of the cycle and then hold it for 10 years and have no growth. You want to get into the cycle after 10 years of no growth and then hold it through its significant explosion where it goes up 150%. And then obviously the refinance, cash out, and then look for the next suppressed market. Perth, same again. Perth is going gangbusters now, second half of the cycle. But in the first half of the cycle, from 2013 to 2022, it went back 30, 40%. So first half of the cycle, Adelaide, Brisbane, Perth do not perform well. And then the second half, they do. And now Perth, I've even speaking to some agents over in Perth recently, it's got so competitive in Perth now. Sales agents that, in order to get a listing, a sales agent, when they have their listing presentation with a vendor to sell their property, in order for the sales agent to win the listing, they need to have at least 2 or 3 buyers lined up. So the sales agents have almost turned into buyers agents at the same time. It's absolutely crazy. So it's super competitive. Everything's running to auction. You pretty much have to pay overs because it's got in the midst of its bull run. Perth, from as you can see, look how volatile Perth is. Main reason for that is a lot of it is propped up by the mining industry. It's almost like a big mining town. It's very dependent on the mines. So that's why even throughout the GFC, in the second half of the cycle previously, it outperformed for a few years while there was the mining boom, and it wasn't until 2013 where it had its significant slowdown. So for me, Perth, I don't know if I'm a super fan convinced. I like more stable, consistent growth, and you can find that definitely in Sydney, Melbourne, regional Victoria, regional New South Wales, and Queensland, and Brisbane. Perth, Adelaide, Darwin, Canberra, these markets are a little bit more too volatile for my liking. I like a little bit more stable, but interesting to keep an eye on. Sydney, we are now ploughing into Sydney and Melbourne for this reason. It's soft market in certain pockets. We're here in 2024, but the equivalent again is 2004. Flat to soft for the next 2 years, and then from 2027 or 2026, it'll then lead. Sydney and Melbourne lead the first half of the cycle. So from 2027 onwards, Sydney's going to be going gangbusters based off history. And look at that growth from 2008 all the way up to the 2017, in the first half of the current cycle. Went gangbusters, 150%, and then it topped out, came back 20%. It's been flat for, I mean, we're finding pockets in Sydney. We're buying property for the same, if not cheaper than people bought in 2015, 2016. So Sydney units, we're picking them up. I mean, if you've been following me, you see we're picking up units for anywhere between 320,000 to 350,000. So at rates that people were buying, yeah, as in 2015. So very good opportunities. There's less competition, get very good deals under bank value, and it will be only a matter of a couple of years where it'll then kick into its next growth cycle, and these certain pockets are going to go up 150% based off history. Same goes for Melbourne. Melbourne's probably a little bit more stable in certain pockets, but first half of the cycle again, has had well outperformed, and then in the second half it's been flat, not as much of a volatile market, Melbourne, which is good. But yeah, for the next probably year or two, we're seeing Melbourne stagnate and being flat. Again, we're finding markets in Melbourne that have been flat for 7 to 8 years. So we like to start buying in markets after once they've been flat for 7 to 9, 10 years, because it's only a matter of when, not if, they will kick into their next growth cycle. Typically anywhere between 10 to 12 years, a market can be flat before it then goes through its significant bull run of 3 to 5 years of growth where it goes up 100 to 150%, and then it'll come back, top off, soften 20, 30%, and then go through its next period of 10 or so years of flat growth. So as I said, we like to get into the markets after the period of flat growth, because it's only a matter of time when they are going to go gangbusters. And what really makes me excited is all these wealthy migrants that have come into the country the last 2 years are ploughing into Sydney and Melbourne. They're ploughing into the markets that have been flat for the last 8, 9 years. They're getting all the population growth. They're primed. They're soaking up all the rental stock. Higher rents get capitalized on higher price. It's only a matter of a couple of years where we'll go through the next land-driven downturn, and Sydney and Melbourne will then lead. If that is all too much information for you, this is a little bit easier way to congest it of where I see the markets now in 2024. We have Adelaide pretty much past its FOMO and about to top out and hit the market peak, and then it'll go through a period of 10 years of flat growth. Brisbane's in FOMO. Everyone's talking up the Olympic Games and ploughing in. Perth is on its way. So Brisbane, Perth. So Adelaide's probably got another year or so of growth, maybe 20, 30%. Brisbane's probably got another 50% growth. Perth's probably got another 60 to 70% growth before they all top out. But the mainstream are ploughing into these markets because for whatever reason, people only get confident when they like to buy into markets once they all start booming. Um, you know, it's when you see it on mainstream news, or your butcher, your hairdresser start telling you about buying property in certain markets where you know that it's probably not a good time to buy. So a lot of people that keep buying in these Adelaide, Brisbane, and Perth will get burnt when the market turns post 2026, because they'll probably overpay, or they'll do something even worse, such as buying new or off the plan at the peak of the cycle. The market will top out and it'll go through a period of 10 years of flat to 20, 30% negative growth, and they'll lose their shirt, especially if they can't hang on to it with higher interest rates. Whereas we are now value investors. We like to invest counter-cyclically. We like to invest in the markets that are suppressed and depressed because you can get good deals. You can negotiate hard on with the sales agents. You don't have competition. You're really the only one looking at the property. I guess it's a bit opposite to what most people think to do. A lot of people are talking down Melbourne with the $50,000 land tax threshold, and it's been pretty much stagnant for the last 8, 9 years and had a hard time through COVID. This is the perfect time to buy into Melbourne and Sydney in preparation for its next growth cycle. When and then where I've got property in Queensland and Brisbane. I'm now refinancing pretty much every property in Brisbane because it's had 150% growth, pulling the cash out to then deploy into Melbourne and Sydney and regional New South Wales and regional Victoria in preparation for the next growth cycle. And when Brisbane tops out in, say, 2026, 2027, I'm looking to sell some smaller assets. So I've got 2 townhouses up there, probably flicking for about 500 grand. I bought one for 152. I bought the other one for 165. So I could sell them today for probably 380, 400, but I think there's another 50% or probably 30%, 40% growth. So once the market tops out, I will vacate the tenants. One needs a new kitchen. They're functional, but when I go to sell, I'll replace the kitchen. The other one needs a new bathroom, rip up carpets, do flooring, paint the joints up, tidy them up. When it's FOMO and absolute peak of the market, and I'll run it to auction. I'll get the best sales agent I can find, who's got the best following, best social media, really push the marketing. I'm all for spending money to make money. I mean, me as a buyer's agent, I wouldn't sell something. I don't know how to sell stuff. I only know how to find value to buy. So I've got no problem with paying a professional to sell a property, and I would run it to auction. I would never buy at an auction, but I would sell. And I would looking to sell those assets that I can't add value by way of development, because I'd rather sell, argument's sake, a unit, 2-bedroom unit for 500 grand that I've got 150 grand loan against, pay off the debt, raise cash, pay the capital gain, net 300 grand each, to then reinvest that as a deposit into a block of 4 to 5 units down in Victoria in a suppressed market. So pulling the money out of a hot market, putting it in a suppressed market in an asset that's got a greater rate of return is a no-brainer. So that's when the only time I would say sell is only if you're going to reinvest into an asset that's going to return you better. So if you're going to sell one to buy 4, do it. Next is forecast. So looking into the future, this is the RBA's forecast on inflation. They believe inflation will hit the 2 to 3% band in late 25 and approach the midpoint so hit 2.5% in 2026, which is quite interesting. The fact that they are saying that, because if you overlay that information on the 18-year land cycle, the land market is due to peak in April 2026 in America, and America leads the global economy, and Australia historically trails 6 to 12 months behind. So all worlds are going to collide. Inflation will come down. Rates will probably top out in 2026. Inflation will be coming down in 2026, and then the market will turn, and then rates will be back to zero before you know it. So it's quite interesting. The RBA doesn't really know about the land cycle. If you look into it and if you follow Philip J. Anderson, and if you read a book called The Corruption of Economics, economics consists of, in the 1800s, land, labor, and capital. A lot of people in government owned a lot of land, and they didn't want the mainstream to understand how the economic structure worked. So in the 1900s, they wrote out land as a mechanism of the economy and only labor and capital. So that's why anyone who talks mainstream economics doesn't understand where the market's heading because they only got 60% of the equation in the picture, labor and capital. They don't have land. So this is why you shouldn't follow mainstream and do your own research. CPI inflation is also being propped up by housing and market services, the main. So if you look at the brown and the red, housing, I guess, is rents. So that's going to keep elevated for a while. So that is what's building up the inflation rate. Rents. This is the CPI rents, which are now booming in the second half of the cycle. So, and these higher rents will get capitalized into higher price. So as the yields keep growing in value based off the rents rise first and then prices then follow. So good for the property investors. Another interesting piece that I like to keep a track on is the unemployment rate. So historically, once the unemployment rate starts to tick up, it then shoots up. So this is the GFC, and then this is COVID. We are now seeing that the unemployment rate is coming off a very low base. It's been the lowest since the 70s, so lowest in 50 years. It is ticking up, so keeping a good eye on it because once it starts to go, it'll shoot up to probably 10%, which is probably when we'll enter the land-driven downturn in the later half of 2026. So a couple more years to go. So be wary of your job and be cashed up to sail through the noise and cashed up to take advantage of the great deals because the deals will be popping. This is the forecast from the RBA. So, I mean, they're saying this is potential worst case. Unemployment could get up to 6.5% by 2025, 2026. I don't believe so based off the 18-year land cycle. I don't see it dropping down either. Once it starts to go, it's pretty hard to get it back unless they drop the interest rate. Because when they increase the interest rates, businesses are now struggling because they've got debts, so they start laying off people. That's why the unemployment rate's starting to increase, which is suppressing inflation, but inflation's not down to the 2 to 3% target yet. So only if they drop the interest rate, but they're in a rock and a hard place because inflation's still too high. So I think it'll more or less be on their black forecast, probably more to the higher side, and then come late 26, 27, it's going to shoot up to 10%, in my opinion. So be ready to, one, potentially could lose your job, and you could potentially lose tenants. If tenants have jobs and they lose their job, then you might lose a tenant. So cash buffers, make sure you got cash buffers in play. Two biggest risks in property is rising costs. So that can be either through higher holding costs of interest rates, maintenance upkeep, or loss of income. That can either be your personal income or losing your tenants. So cash buffers in play to make sure that you can hold your assets and you're not forced to sell. And really residential real estate, you can replace a tenant within a month or two. It's not like commercial real estate where they will go vacant for 3 to 4 years in the next land-driven downturn. So a lot of people that are heavily leveraged into commercial will feel the pain and potentially even go broke. So watch this space. Another thing that's quite interesting is the Australian investment lending for homes. So this is the amount of credit that is people are now borrowing. So it's now on the run. It's almost at the all-time high. So 2004, like had a spike, softened into the GFC. Into the GFC, and then from 2012, the recovery in the first half of the current cycle into 2015, slowdown and a little bit of a comeback into 2017, and then this here was the APRA credit crunch where they restricted lending. They thought the market was getting too hot, so that was a pretty significant slowdown. That's when I actually bought my first property in 2017 and tried to sell it off my old original strategy of flipping, which before I discovered the building the portfolio strategy. And that credit crunch from APRA saves me from selling the asset and not building a portfolio today. So very lucky that that happened. But so that is a slowdown from the credit crunch, and then COVID hit and they dropped interest rates to zero. Then every man and his dog was borrowing like crazy, and that's what kicked off the boom in 2022. Had a bit of a slowdown, and then now it's on the run again. So with higher rates, interest rates, banks are earning higher profit margins. So they'll start to lend more freely into the market. They'll start taking on more risk. They'll start making more creative ways to lend. For example, if you're refinancing a loan, there's some banks out there that don't put the 3% buffer on anymore. So they're finding new creative ways to loosen lending to keep their loan books turning over because they can, because they're a commercial business, and now that they're earning higher profit margins, that they can afford to take on bad debts or riskier borrowers and still have enough skin in the game to sell the property underneath the borrower if they can't meet their repayments because they're earning a higher profit margin as a business. So CBA is currently the biggest listed company on the ASX, took over BHP, and this is classic behavior we see in the second half of the real estate cycle when interest rates are higher. So, and then when credit starts to expand and credit floods into the market, people will have more money to spend into the market. If they got more money to borrow and buy property, then the market will keep pushing on. So it's a little bit of a, I guess, counterintuitive to what is, I guess, mainstream, where people say, well, if rates are higher, lending is restricted, people's borrowing capacities are restricted, so people can't buy as much property. Yes, however, banks will find creative ways to allow lending to keep turning over. And they do more so now with higher rates than they would have back in when rates were lower at 2% because there's less margin that the banks are making. So they can't afford to take higher risk. So banks are now taking higher risk. And we saw this, especially in the United States, pre-GFC, so between 2004 to 2007, where you could pretty much go into a bank, not even prove you had a job and get $1 million loan drawn up. So this crazy euphoria credit creation is on the way. It's coming back. So it hasn't hit all-time high yet, but it's going in the right direction. And that will ultimately more lending, more credit expansion will all filter down to the benefit of land price and property prices. Exciting times ahead. So the Australian auction clearance rate. So we are now in the spring selling season. We're here. Happy days. So what does all this mean? So the clearance rate, auction clearance rates are an indicator. So for everything that goes to an auction on a Saturday, these percentage points are what actually sells and what gets passed in. So Victoria, 60% sold on the weekend. New South Wales, 57%. Queensland, 48% sold. South Australia, 77. WA, 55. Northern Territory, 100%. That's pretty crazy. And ACT, 62. Tassie, not much goes to auction. So when the clearance rate is above 70%, that is considered a booming market. I mean, you'd say, oh, what's going on with Western Australia? Not as much goes to auction in WA. So when it's sub say 50, that's when it's more of a suppressed market. And these indicators can be used more so for a short-term indicator of how the market's going. So spring, now we're in spring, most people think it's a good time to sell in spring because of the lighting, the warmer weather, the way the property presents. That's their mindset or their thought process of, okay, I'm going to hold off and sell in spring. But it's not a good time to sell in spring because lots of people think that way and lots of people do that. And then lots of people put their property on the market and then they flood the market with a lot of listings, a lot of properties to sell. They hold out through winter. And so historically, we see a lack of sales listings on the market during winter. And then until spring, and then everyone floods the market, and then that then suppresses prices for a couple of months coming into Christmas because there's lots of options. It's like going to Myer and buying all your winter clothes now that we're in spring, buying all your suits and jackets and stuff because there's all this extra stock and they're trying to get rid of it by Christmas and it's summer and there's so much leftover stock. So similar concept. I really like buying in spring and before Christmas because there's lots more options out there, and when there's more options there's less competition because there's a higher supply, and the demand is still there, but when there's more supply then there's less competition because there's more options out there. So good time to buy now and coming into Christmas. And when I go to sell, I'm going to sell in June, July when it's coming into or in winter when there's less stock on the market, because when there's less stock and there's the demand's always there, then you get a good price. So sell around that May, June, July, and really good times now to buy in spring or Christmas, and especially December. December is probably the best time to buy, is because you get that leftover stock out of spring, and if they haven't sold, the vendors thinking, shit, I haven't sold, and they might have made it, tarted it up, make it pretty, give it a lipstick to sell, and they haven't had much luck because there's lots of other options, lots of stock on the market. They've maybe vacated the tenant. They're not getting any rental income. If they don't sell in December, they're not going to sell until February because everyone's thinking about Christmas holidays and parties and going away. So December's a really good time to buy because you get that urgency, you get the blood and if you can smell the blood in the water, you can negotiate really hard, and if you offer good terms and you're willing to move quickly, you could snatch up a good deal and get a good 50, 100 grand under bank value. So now's the time to get ready. If you want to get in the market, really good time to buy now. Another interesting thing is Berkshire Hathaway is sitting on almost $280 billion in cash. He's cashed up. The big man, Warren Buffett, probably the most famous investor in the world, has flashed or sold off half his stake in Apple. So probably should have got the Apple share price. That'll be interesting to know. Apple share price. Let's see. Oh yeah, Apple share price is at all-time high. Holy hell. So it's at $220 as of today, or 220 US dollars, that is, on the Nasdaq. So Mr. Buffett sees the writing on the wall. He's cashing up, exiting out of half of his stake in Apple. It's at all-time high, and he's stacking cash, getting ready for the blood on the streets, which is pretty good. Getting ready. So when you see the one of the most famous, wealthiest investors in the world stacking cash, that's when you know it's a good time to do the same. So you can use this information into property as well. He's obviously preparing for the land-driven downturn, which during the land-driven downturn, the stock market historically takes a 50 to 60% hit. So that's the index. Individual stocks can some get wiped out if they're carrying too much debt. Um, so he's stacking cash to take advantage of when the market turns, when um, his famous quote is be greedy when others are fearful and fearful when others are greedy. So right now people are greedy. They're probably plowing into Apple, buying it because it's going all-time high. This is a similar thing what people are doing in Brisbane, Perth, Adelaide. They're plowing in. They're all greedy. They're plowing in. You want to be fearful. You want to be stacking cash. You want to be getting ready and looking at other opportunities such as in Melbourne and Sydney. And definitely when the market turns, you want cash because there'll be opportunities everywhere. There's another famous saying. He says you pretty much just have to walk outside and it's raining gold, along the lines of that. So he's stacking cash. He's got 280 billion bucks worth of cash ready to go. Plenty of dry powder to inject back in the market once the market turns. So that's pretty interesting. Also, Jerome Powell has shifted his tune, saying it is coming time to change policy in relation to cutting interest rates. And historically, Australia trails 6 to 12 months behind the US. So I like keeping an eye on what's going on in the United States because the 18-year land cycle is based off the States, and the UK and Australia trails. So last time the GFC here had a good run. So this is between 2003 to up to 2007, 8, flat, and then once the market turns, we'll be back down to near zero again before you know it. So hang in there. It's probably another until I'd say mid 2026 for interest rates to stay where they are, maybe a couple of notches higher, and then they'll top out, and then they'll be back down to zero, and I'll be refinancing all my loans, getting a good rate, and locking them in for as long as I can at 2% again. I can't wait. Politics. Another thing that drives the market, or definitely influences the market for that matter, is US politics at the moment. So Trump is shaping up to be similar to Ronald Reagan back in the Reagan years of the 80s from 1981 to 1989. Ronald Reagan was pretty similar to Trump's style. His similar policies of um, which I'll get to in the next slide. But what is really interesting is Robert F. Kennedy Jr. is the part of the Kennedy family. He dropped out of the race as a Democrat to join the forces with Trump. So Trump is a Republican. So he's dropped out of the Democrat, which is in the States, the Democrats are pretty much like the Labor and the Greens combined in um, in Australia. So if we got the Greens and Labor and we merged them together, that's pretty much the Democratic Party, and the Republicans are like the Liberal Party in Australia. So Trump is a liberal in Australian terms, and so a very well famous um, Robert F. Kennedy Jr., who was the nephew of blow my mind now, but he was a famous Democratic president in the 70s, I believe, maybe earlier, who actually got assassinated. Um, they were always a Democratic family, and he's now saying that the Democratic Party has changed to what it was in the 70s and 80s. Um, it is no longer, I guess, for the working class, for the people. It's more big tech, um, a lot of corruption in the Democratic Party. So RFK is now supporting Trump for the reasons of ending corruption in the health industry. So there's a lot of in the States, a lot of the pharmaceuticals make a lot of money on just selling drugs and keeping everyone sick. So he's trying to change that, protecting children of all sorts of, I guess, health issues from the corruption out of the health industry, rebuild the industrial base and the middle class, no wars. So wars are breaking out everywhere now, in the Middle East, Ukraine, and China is, getting forces all revved up for taking over Taiwan. So all for no wars and freedom of speech. So there's been a lot of, I guess, Trump's created his own Truth Social just to get his word out there, because the Democratic Party has been trying to censor Trump and what he's had to say over the last couple of years, and suppressing what the mainstream see, which is pretty much what is done in dictatorship countries such as China and Russia. So uh, in China and Russia, they censor the information that gets out there, and they don't allow people to understand the actual reality of all the situations. So that can be a slippery slope. So it's pretty amazing to see such a famous Democratic figure drop out and promote his beliefs and join the race with Trump. And if Trump comes in, which I think he's probably well and truly set on the way, Kamala Harris has had a bit of a sugar hit honeymoon period, and it seems to be dying in the arse now. Looking forward to seeing the debates coming up. But for Trump, his policies are pretty well similar to Ronald Reagan and in the 80s, so 1981 to 1989, where we had a real significant boom, which was off the back of big tax cuts, which Trump is planning to do even bigger tax cuts than what Ronald Reagan did in the 80s. Cutting regulations, so allowing businesses to just crack on and get on with whatever they need to do. But also, I mean, he's a property guy. He'll be cutting banking regulations, so putting the onus back onto the borrower to make sure that the borrower can borrow the money and not the banks, which is what Obama brought into after the GFC, which wasn't in play before the GFC. That hence why they could have gone into the bank and get $1 million loan without proving they had a job. So Trump's going to bring that back. And with that, there'll be mass credit creation that'll also be soaked up for the benefit of land price. He's going to drill oil to lower energy costs, so lower the cost of at the petrol bowser, lower the cost of heating, lower the cost of energy, which filters in to the cost of inflation. Everything needs energy. So if oil's high and transport costs are high because trucks need diesel fuel to cart food around the country, they just pass that on to the end consumer. So sure, you can try and save the planet and go completely green, but you end up losing your shirt because everything inflation will go through the roof because there's if there's not enough oil supply, prices go up, the cost of fuel goes up, and then that ends up getting pushed onto the end consumer, and then people start paying for it the at the groceries. So at the shops when they go, like I mean, the other day I hit the record. I seem to get amused by myself when I'm at Coles and at the checkout station. And I've only got a young family, wife and two boys under 2, and hit the record the other week, $618. I mean, I'm not complaining. Inflation's good for property investors. The properties are going up like crazy as well. So, but that is energy costs around the world. So when the United States has as much oil as Saudi Arabia, but they're not using it because they've got a greeny government in play that's cut off all oil supply, and they end up importing it from other countries, then prices go up, and then that ultimately gets pushed on to the end consumer for everything. So, it's robbing Peter to pay Paul, but how do you want to live your life? Cut the Fed funds rate. So ultimately, he'll drill oil to bring energy costs down globally. So we'll then be able to Australia will be able to import oil from the States as well at a cheaper rate than coming in from the Middle East. So that'll then lower inflation to ultimately allow him to then influence the Federal Reserve, which they're already sort of on their way to drop the Fed funds rate, which is also known as the cash rate in Australia, because ultimately he wants interest rates at 2%, easier to borrow money, easier to do business, easier to buy property. When you can borrow more, you can pay more for property, it goes up in value. So he's got vested interest in property. Obviously, he wants low interest rates, better cash flow if you've got a big portfolio, and he's pro crypto. So that's going to be the next euphoria explosion. Uh, if he comes in November 2024, we'll well and truly be set on our way. The last couple of years of this mania of the last 2 years before the market tops out in 2026. And based off Akil Patel and Phil J. Anderson, they don't believe Trump will elongate the 18-year land cycle, so push the top further than 2026. As in, will Trump? I recently caught up with them a month or so ago, and was this question: these policies, will it my question was, would it push the 18-year land cycle to top out in 28, 29 and then crash? And they said they don't believe so. They think we're still on course. The land cycle is a bigger beast set in its course. It's a global cycle now with all westernized economies. However, Trump's policies will give it a sugar hit, and the boom is going to be off the charts. So the boom will go higher, and it'll crash harder post 2026, especially if crypto comes into play. So if people can start borrowing against or using their crypto as security. So if someone's got a couple of $1 million worth of crypto, they could, if Trump comes in and he's pro crypto, I'm sure we'll see things like you can go to the bank and get a loan against your crypto portfolio to use that to buy property. And if that happens, then that will then send the property market to its next level. And then it'll be interesting to see how cryptocurrency survives through the next land-driven downturn, as it is pretty much a speculative asset with no earnings. Who knows what it is? Blockchain pixie dust. And which wasn't around. Crypto came in around 2012, 2011, 2012 after the GFC. Crypto has never gone through a land-driven downturn, so it'll be very interesting to see how it performs. I wouldn't be surprised if most of it gets wiped out. So time will tell. Just a disclaimer, a bit of housekeeping. This content is general in nature and by no means personal or general advice. This is my thoughts, story, how I see the market playing out in the coming years. Prior to making any investment decisions, you should seek independent advice in relation to your property acquisition. I am obviously, if you know, you've been following me for a while, I'm a buyer's agent. So if you need help buying an investment grade property and building a portfolio of 10 properties within a 10-year period, sustainable property, solid residential property portfolio, I'm your man. I can help you. I've done it myself. I've got to 17 properties now within 7 years. So if you have any questions, comments, feedback, you can always email me. Email's on the screen. As always, don't get carried away with the herd. This is a time where most people will get fear of missing out, become reckless, emotional. They will not pay attention to the fundamentals and will definitely potentially get themselves burnt when the market turns post 2026. So stick to your fundamentals: underbanked value, under rebuild costs, strong cash flow in a growing population in an area that will gentrify with a good balance of both capital growth and cash flow, and you will do well. Till next time, see you then.